Bitcoin doesn't reward the lucky. It rewards the disciplined, the traders who study patterns, calculate risk, and master patience in a world built on emotion. Steve Holmes begins trading Bitcoin with a hard truth. The market doesn't owe you clarity. Every time you hit buy, you're entering a world ruled by probability, not promises. Every candle, every spike, every crash, it's all a reflection of human behavior. The winners in Bitcoin aren't the ones who predict best. They're the ones who adapt fastest. They understand that volatility isn't chaos, it's opportunity, but only if you know how to read it. This book breaks down the structure behind the madness, the patterns, tools, and rules that separate emotional traders from methodical ones. If you've ever wondered how professionals make sense of the storm, how they use RSI, MACD, Fibonacci, and risk control to find order in the waves, this is your roadmap. Because in Bitcoin trading, success doesn't come from guessing where the market is going. It comes from knowing what to do when it gets there. Part 1. Market structure and price behavior. The foundation of trading starts with one concept: market structure. Every price movement, whether in Bitcoin or any other asset, follows a rhythm of highs and lows. These patterns form the backbone of every professional analysis. There are only three types of structure: uptrend, downtrend, and consolidation. An uptrend is a series of higher highs and higher lows. Price is climbing, momentum is strong, and buyers are in control. A downtrend is the opposite: lower highs and lower lows. Sellers dominate and every bounce fades. Consolidation happens when neither side wins. The market moves sideways, storing energy for the next big move. Steve Holmes teaches traders to start from the higher time frame. Zoom out to the daily or weekly chart before you ever open a trade. Ask yourself, is Bitcoin trending up, down, or sideways? Because trading against the dominant trend is like swimming upstream, possible but exhausting. Once you identify structure, look for key levels, areas where price has repeatedly bounced or reversed. These zones aren't random. They're where emotion meets logic, where buyers and sellers have fought before and will fight again. Professional traders mark these levels first: support below, resistance above. Only then do they drop to lower time frames to find entries. That's how the best traders stay aligned. Top-down analysis, from big picture to small detail. Market structure is the compass. Without it, every candle feels like noise. With it, every movement makes sense. Part 2. Candle psychology. Every candle on your chart is a short story about control. The body shows who's winning, buyers or sellers. The wicks show rejection, where one side tried to push but failed. A long green candle with a small wick? Buyers dominated that period. A long red candle? Sellers crushed it. A doji? Where open and close are nearly the same. That's indecision, a standoff. Steve Holmes urges traders to stop seeing candles as shapes and start seeing them as decisions, because each pattern reflects emotion. When you read those emotions correctly, you can anticipate the next move before it happens. Let's decode a few of the most powerful patterns. Bullish engulfing. A large green candle completely covers the previous red one. Buyers have taken control, a potential trend reversal. Hammer candle, a small body with a long lower wick. Sellers tried to push price down, but were rejected by buyers. Common near bottoms. Shooting star, the opposite of a hammer, a small body with a long upper wick. Buyers pushed up but failed to hold, often signals exhaustion near tops. Doji, market uncertainty. After strong momentum, a doji can mean the move is losing steam. Professional traders never trade a single candle in isolation. They read context, where it forms, after what kind of move, and near what level. A bullish engulfing at a major support level means something. That same candle in the middle of a choppy range, it means nothing. Candlestick psychology is the language of traders. Once you learn to read it, every chart starts to speak. Part 3. The core indicators. Indicators don't predict the future. They translate emotion into data. Each one gives you a different angle on what's already happening. Steve focuses on a few key tools that every serious trader should master. RSI, the emotion meter. The Relative Strength Index, or RSI, measures momentum, how fast price is moving and whether it's overextended. RSI moves between 0 and 100. Above 70 means the market may be overbought. Too many buyers, not enough sellers. Below 30 means it's oversold. Too many sellers, exhaustion in the air. But pros don't use RSI to time reversals blindly. They use it to read strength. If price makes a higher high but RSI makes a lower high, that's bearish divergence. It signals that momentum is fading, even if price still climbs. If price makes a lower low but RSI rises, bullish divergence. Buyers are gaining quiet strength. The best traders use RSI as confirmation, not command. It's not about RSI says buy. It's about RSI shows what emotion the crowd is feeling. MACD, the pulse of momentum. The MACD, or Moving Average Convergence Divergence, reveals when momentum shifts. It's made of two lines, one fast, one slow, and a histogram that measures their difference. When the fast line crosses above the slow line, momentum is turning bullish. When it crosses below, bearish. The strength of the histogram bars tells you how strong that momentum really is. Here's how pros use MACD. When both price and MACD rise together, the trend is healthy. When price rises but MACD weakens, something's wrong. Momentum is fading. Steve calls MACD the truth detector. It ignores hype and shows you the underlying energy driving price. Moving averages. The direction guide. Moving averages smooth out price and reveal trend direction. The 50-day and 200-day moving averages are the most watched. When price is above both, the trend is bullish. When below both, bearish. When the shorter average crosses above the longer one, it's called a golden cross, trend reversal upward. When it crosses below, a death cross, downtrend ahead. But the secret is this: moving averages don't tell you when to enter. They tell you when to stay patient. Steve advises traders to use them like rails on a track. If Bitcoin is above the 200-day line, dips to it are potential buys. If it's below, rallies into it are potential sells. It's not prediction, it's context. Fibonacci retracement. The pullback map. Markets move in waves, impulse, correction, continuation. The Fibonacci retracement tool helps you measure those corrections. The key levels are 38.2%, 50%, and 61.8%. These aren't magic numbers. They're psychology. Because traders around the world watch them, they become self-fulfilling. When many traders believe Bitcoin will bounce at 61.8%, they buy. And it actually does. Example: if Bitcoin rallies from $30,000 to $40,000, a 61.8% retracement suggests support near $34,000 to $35,000. If other signals align, bullish candles, RSI recovery, MACD cross, that's your potential entry zone. Use Fibonacci to plan patience, not to guess, but to react intelligently. Volume, the voice of confirmation. Volume shows how many participants believe in a move. A breakout with low volume is a whisper. A breakout with high volume is a roar. Steve teaches that volume confirms conviction. If Bitcoin breaks above resistance but volume doesn't rise, pros stay cautious. The move might fail. If volume spikes on the breakout and continues climbing, that's confirmation. In short, price shows movement. Volume shows belief. Part 4. Combining indicators into strategy. Now that you understand the tools, Let's put them together. Steve's strategy focuses on confluence, stacking multiple confirmations for one decision. Here's an example setup. 1. Identify the trend on the daily chart using moving averages. Bitcoin is above the 200-day and 50-day, clear uptrend. 2. Mark structure levels. Previous resistance at $40,000. New support around $38,000. 3. Wait for a pullback. Use Fibonacci retracement from $35,000 to $40,000. Price dips to the 61.8% zone. Potential buy area. 4. Check RSI and MACD. RSI recovering from 35 to 50, showing reduced selling pressure. MACD histogram turning positive, bullish momentum returning. 5. Watch candle patterns. Bullish engulfing forms near support. Volume increases. Conviction. Now, the setup is clear. Entry. Near $38,000, stop loss below $37,000. Target near $41,000. Risk, $1,000. Reward, $3,000. That's a 3-to-1 risk-reward ratio. Professional grade. That's how confluence builds confidence. Each indicator alone means little. Together they tell a story. And in that story lies probability. Part 5. Risk, leverage, and position management. If analysis is your sword, risk management is your shield. Most traders fail not because they're wrong, but because they're overexposed when they are. Steve Holmes repeats this throughout the book. Your first goal is survival. Everything else comes after. The rule of thumb is simple. Never risk more than 1 to 2% of your account on a single trade. If your account is $10,000, that means $100 to $200 risk per trade. Use position sizing to calculate this. If your stop loss is $500 away, divide $200 by $500 equals 0.4 BTC position size. That's how pros ensure losses stay manageable. No guessing, no emotions. Then comes leverage. Leverage amplifies everything, profits and losses alike. 10 times leverage means a 1% price move equals 10% on your account. Used carelessly, it's a ticking bomb. Used wisely, it's a precision tool. Pros use small leverage, 2 times, 3 times, maybe 5 times. Only when their edge is clear and risk is fixed. They never risk more than they can lose comfortably. Risk control isn't exciting, but it's what keeps you in the game long enough to see success. Trading is survival first, profit second. Part 6. Execution, adaptation, and growth. Trading is a skill, not a moment. It's a marathon of repetition, review, and refinement. Steve emphasizes testing and journaling, the 2 habits that turn knowledge into mastery. After each trade, write 3 things. 1. What was your setup? 2. Did you follow your rules? 3. What emotion did you feel during the trade? Over time, your patterns appear. Maybe you notice you overtrade after losses. Maybe you perform better on certain time frames. That awareness becomes your edge. Backtest your strategy. Run it over historical Bitcoin data. See how it performs through bull runs, crashes, and consolidations. If it works consistently, stick with it. If it fails, refine it. Adaptation is what keeps professionals alive in changing markets. There is no single perfect strategy, only systems that evolve as you do. Because the truth is this: the best traders don't beat the market, they align with it. They understand that chaos is constant, but behavior is predictable. They don't fight emotion, they read it. They don't chase trends, they follow structure. That's how mastery is built, one disciplined decision at a time. Steve Holmes' Trading Bitcoin isn't just another book on charts. It's a manual for rational thinking in an emotional world. It teaches you to see markets as reflections of behavior, not randomness. To respect risk before chasing reward. To measure emotion through data, and to act only when logic aligns. Because at the end of the day, trading isn't about being right. It's about being consistent. Every indicator, every strategy, every lesson points to one truth. Success belongs to the trader who can stay calm when everyone else panics. So study the patterns, respect the risk, and let patience be your greatest position. Because the goal isn't to win every trade, it's to stay in the game long enough to let probability do its work. That's the golden rule of Bitcoin trading. And once you master it, the market finally starts making sense. If Steve's message hit you, if it made you rethink how you trade, how you manage risk, or even how you approach growth, then this is your moment to act on it. Growth only starts when knowledge turns into action. So here's my challenge to you. Drop a comment right now. Tell me, what's the single biggest lesson you're taking away from this summary? Was it patience, discipline, or finally understanding how pros see risk and reward? Your insight might be exactly what another viewer needs to hear today. If this video helped you see Bitcoin trading with more clarity, hit that like button. If you want to grow your trading mindset and master financial discipline, subscribe right now, because that's exactly what we do here. We turn books into breakthroughs. And if you know someone chasing the next crypto trend without understanding the risk, share this video with them. You might just save them from their next bad trade. Because at the end of the day, knowledge multiplies when it's shared, and growth begins when you decide to keep learning.